I'm Ashton Addison from EventChain for Investment Pitch Media and FinTech News Network. And today on Blockchain Interviews, we have Marshall Auerback, market commentator and research fellow at the Levy Institute. Marshall, welcome to the show, and thanks for taking the time to be here.
Thanks for having me, Ashton. It's nice to be with you.
You're very welcome. I know you have a lot of years in the financial industry, and I'd love to just get a little bit of background on yourself to get us up to speed, and what are your recent focuses right now?
Okay, well, yes, I've been at this for over 25 years. I started in Asia in the 1980s. I spent time in both Hong Kong and Japan, where I think I saw the bursting of a few interesting bubbles. So I got very used to the market dynamics, both bull and bear markets. I subsequently moved over to Europe, in London, where I worked over there, and also in New York. I covered emerging markets. Later on, I began to evolve and get more involved in policy matters and academic matters. So I've looked at the market from the perspective of being both a market theoretician, practitioner, and also quasi-academic. The last few years, I've been involved in a think tank, and now I have an academic affiliation with the Levy Institute.
That's great. And yeah, there's, especially on the academic side and politics right now, there's a lot of decisions being made, at least throughout America. And I know that you've also devoted quite a bit of time to the Modern Monetary Theory, MMT. Can you explain a little bit about MMT and then how it applies to everyday consumers in this market right now?
Yeah, I mean, there's been a lot of good work done on it over the last several years, the most recent being Stephanie Kelton's book on modern monetary theory. But I think the major takeaway is the idea that many of the constraints that we talk about when we're looking at fiscal policy, government fiscal policy in particular, are as basically they're more apparent than real. There are real resource and inflationary constraints that should drive policy, but there's no fixed or a priori idea of what is financially sustainable. You don't have to look at government finances the way you would look at a household finance, especially not in a situation where we live in a world of fiat currencies, where governments issue currency without constraint. We don't operate on a gold standard anymore. So countries that issue their own currencies have considerably more freedom in the conduct of fiscal policy than has hitherto been surmised in many of the traditional economics textbooks. And I think that's becoming increasingly apparent, especially in today's world, where the old playbook about fiscal policy has just gone out the window.
Yeah, especially right now, it seems there's a lot of printing going on and stimulus needed because of the pandemic, and that fiscal policy is obviously making a shift in the market in terms of where people are looking to get yields. As the interest rates are sort of lower, there's assets moving around, a lot of cash flow is moving into equities, and despite the crash earlier this year, it seems like the market's been doing well on the way to the election.
Yeah, that's right.
Right?
I think other than you get hiccups like today, but it's a very interesting period because remember in the mid 1990s when Robert Rubin was the Treasury Secretary for the Clinton administration, and there was this argument that we have to keep public expenses under control, because if you don't, the so-called bond vigilantes will react. They'll drive up yields, and you'll have a financial calamity on your hands. And now what you've got a situation. The market is actually falling today because of not only the adverse news on COVID, the apparent revival, but also they have tended to react badly whenever there's been a sense that fiscal policy will not be forthcoming. I think increasingly people are aware that when there's a major gap in economic output, you need that fiscal push to sustain economic momentum. And so there is far less concern about the bond vigilantes, if you like.
And with that, to sustain the economy, you need to add this stimulus in, but it keeps interest rates low. And it seems like the Fed is wanting to keep the rates low for, it was 2022, and then they mentioned 2026, and it seems like it could go for years and years. What impact do you see that?
But I think that the Fed, they certainly don't plan to raise short-term rates, and I think they can certainly control the short-term rate structure by what they do in terms of raising or lowering the discount rate. But I think that's also a byproduct of fiscal policy. I mean, this idea that somehow excessive government spending crowds out private expenditures and drives up rates, I think it's been shown to be nonsensical. What generally tends to happen is, the government spends a lot of money. They inject that money into the banking system, into the reserves, and that inexorably drives interest rates lower. So it's not a surprise to me that given these massive stimulus that we're actually seeing lower prevailing interest rates, and that we won't really see an uptick until we see an uptick in economic activity. And I think we've still got a profound deflationary undertow. So I don't think that's given the lost economic output, that we have to worry about that situation just yet.
Well, they say that the trend is your friend, and the market seems to continue going up as the rates stay low, but it doesn't seem sustainable. Is there sustainability there, or what do you do? Are you cautious moving forward into the markets post-election?
Well, I am cautious about the markets, really, in part because first of all, the stimulus is starting to slow down the effect of it, especially in the U.S. They pretty well have just given up on passing any kinds of new stimulus packages. So you're getting Great Depression-like levels of depression and a considerable amount of economic insecurity, which means that the traditional impetus to drive economic growth going forward is not there. Absent economic growth, you don't get the same kinds of earnings growth that you would before. And it's very, very hard to sustain the current market multiples if you don't have any earnings growth. So I am concerned. And I think also my other concern is that the quality of the spending in terms of its distributional aspects are not going to the right areas, and they're not helping to sustain a what I would call a durable economic environment for sustainable growth. And I think that's something that people are becoming increasingly concerned about as well.
Definitely. It seems like the spending was going to, corporate debt, blue chip companies, corporate debt even at some point, and
like
bailouts
Amazon
for
certainly doesn't
industries.
need money right now, and also it's going to companies where look, their models might not be viable. I mean, for example, there's been billions that have gone to Boeing or the airline industries, and as we've seen, these are industries that have been decimated by the pandemic. It's going to take a long time before those kinds of industries recover, if at all, and likewise in things like restaurant, leisure. So that being the case, if you're just going to continue to bail out companies that have no kind of viable economic future, then it means that fiscal policy effectively becomes a stopgap rather than a stimulus.
Definitely. And what's your take on, using that fiscal policy to try and keep those companies alive versus some Silicon Valley entrepreneurs say, let them die, let the cycle happen, and let the private industries take over, either buy up and reinvent the industry and make it better. Because as you say, you can put stimulus in there, but if it's going to continue dying, eventually something will happen where the industry sort of fixes itself.
Well, that's true. Although there's two things that you have to bear in mind, that there is this major gap in economic output, and so you want fiscal policy to help to provide a floor for demand, so that you can get the kind of readjustment that you're talking about. I think the state does have to take a more dynamic role in terms of industrial policy, in terms of helping to facilitate employment in new sectors of the economy, or at least those that are more likely to recover quicker. If you simply just drop it down a sinkhole, as you say, that's not going to solve the problem. But at the same time, if you have tens of millions of people who are unemployed, then businesses won't be investing because there won't be kind of end demand for their products, no matter how profitable the industries are. So you need to fill that gap somehow, or else you're going to get debt deflation dynamics, as you did in the 1930s all across the world.
Yeah, it's super interesting times right now because the first-time unemployment claims are continuing to rise. And the economy doesn't seem to be doing well, but the market is doing well. And some of the politicians try to say like, "Oh, look, it's growing, so we're doing well," but really we're not doing that well if you look at the unemployment.
No, that's right. And I think also, there's been so many interventions, and the incentives have become so heavily skewed that the capital markets are not really accurate gauges anymore of
Mm-hmm.
economic health. I mean, I really do think it is becoming like a casino. And if you have central banks saying we're going to effectively underwrite everything by buying every single corporate bond in sight,
Mm-hmm.
then that's not really a sign of economic health. It's actually the opposite.
Mm-hmm.
So this is why I would have preferred fiscal policy to be targeted less towards the companies and more towards individual people, whether that be
Mm-hmm.
have been through nationalizing payroll, or at the very least providing a minimum income supplement so that people can survive during these tough times, so that when businesses are ready to invest again, that there is at least a decent floor, a decent level of economic activity, so that you're not doing it from the throes of a horrible depression.
Definitely. And we mentioned unemployment. Do you see a proper path for using fiscal policy to try and drive unemployment back to where it was pre-pandemic?
Yeah, well, we've done this before. In the 1930s, we had this thing called the New Deal. It worked very well. I know some people will say that it didn't, but actually, if you calculate the data directly, then FDR managed to reduce unemployment from 1932 to 1936 from almost 30% down to 10%. That's still very high, but it does show that government can at least fill the gaps in demand to help generate employment. And some people can say, well, those aren't real jobs. I would disagree. I mean, I think you could, for example, embark on a very, very large scale of public works expenditure, which would not only enhance productivity, but provide a lot of high paid, highly skilled jobs for a
Mm-hmm.
number of people. I'd rather see that than say have the money go straight to economic bailouts to specific companies. But unfortunately, the way our system is working right now, if you have, it seems that if you're politically well connected and well banked, then you're more likely to get assistance from the government, as opposed to it being a function of actual economic need.
Mm-hmm. And you mentioned sort of having a guaranteed minimum salary, like a universal basic income, essentially. Do you think that that is the proper move, or maybe it's a necessary move, coming
Well,
into
as opposed
2021?
to a UBI, I'm actually more in favor of one of the principal MMT ideas is a job guarantee program where effectively you have the government step in as an employer of last resort. That's much more the type of policy I would prefer to see.
Mm-hmm.
I think it's important to maintain some sort of nexus between work and getting assistance from the government. I think not only from the point of view of social solidarity, so you don't want people to think that there's a bunch of second class scroungers or something like that, fair
Mm-hmm.
or unfair, but also because I think there are certain good habits that are inculcated when you have people experiencing the discipline of day-to-day work, and you preserve social capital, and many of the long-term problems associated with long-term unemployment, whether that be disease, alcoholism,
Mm-hmm.
depression, etc., or just degradation of skills, that tends to be diminished if you have programs which actually target employment directly as
Mm-hmm.
opposed to targeting assistance per se.
Definitely. And it's an interesting fact because it seems like, before the unemployment was fairly low, but there was also discussion of a lot of Americans just had low paying jobs, or they would have two or
Yeah.
three jobs that are all paying minimum wage. And even though they're employed, they're really not that well off.
Yeah, that's right, and that goes to the point. This has been another problem that we've had for decades. Especially in North America and Europe, where, we've outsourced a lot of high quality manufacturing jobs to Asia, so that's a problem. I've never actually believed that you could just have a non-existent manufacturing sector and just say, well, we're just going to do services. It doesn't work like that. And the
Mm-hmm.
other problem, which is much more prevalent today in the so-called gig economy, is that the labor itself is becoming contract labor. So
Mm-hmm.
people that would be normally classified as employees are being classified as independent contractors, which is enabling a number of companies to avoid paying them the traditional benefits associated with employment, whether that be health care or vacation leave, maternity leave, etc.
Mm-hmm.
And I think that is creating a new kind of underlying insecurity for economic insecurity for a number of workers. In the U.S., it's estimated that up to 55, 60 million people out of a population of 300 million are engaged in what we would call contract labor in the gig economy. And I think that's led to what the economist Albena Asmonova has called precarity capitalism. So it's a new stage of even more economic vulnerability. You have a handful of jobs of people in jobs that are providing secure and steady employment. That's not the way it is for a large number of people right now.
Yeah, it's definitely shifted in the workforce as well. And we're running out of time, Marshall, but do you have any advice for people that are looking to stay ahead in the economy as we approach the end of 2020 and beyond?
Well, I think it's a time not to be too brave. I would say that. I think the markets are looking very, very toppy, and so if you've made good profits over the last year, it might be good to take some off the table. I know it's a long-term business, but the downturns when they come can be pretty nasty. So I would say now is the time to maybe husband some of that cash, conserve it a little bit, and wait for a better opportunity sometime, hopefully in the next several months.
Definitely. Great advice, Marshall. Thank you so much for your time. It's been a pleasure speaking with you. All the best moving forward, and let's follow up in the near future.
Thanks for having me, Ashton.